Do not be deceived by the headlines celebrating a 10% credit card cap or 6% mortgages. Do not accept the narrative that lower interest rates signify a healthy economy. Most importantly, reject the claim that this is a victory for the American consumer. What is unfolding in January 2026 is the most hazardous experiment in American monetary policy since the suspension of the gold standard. The executive branch has effectively declared war on the price of money. History offers a brutal lesson regarding governments that manipulate the cost of credit for political leverage. Someone always pays. In this scenario, that someone is the saver and the taxpayer. Market fundamentals have been abandoned, stock valuations have detached from corporate earnings, housing prices have detached from supply and demand mechanics, and interest rates no longer reflect risk. Every metric now reflects a singular variable: the administration's strategy to secure the 2026 midterm elections. We have entered the era of political money, and this is the great repricing. The current dynamic in Washington is unprecedented. President Trump, facing the pressure of the upcoming midterms, requires an immediate perception of affordability. With credit card debt at $1.23 trillion, average APRs at 21%, and mortgage rates previously near 7%, voter sentiment is critical. Standing in opposition is the Federal Reserve, an institution designed in 1913 to remain independent of such political cycles. The Fed's mandate is to make unpopular decisions, raising rates to curb inflation, regardless of electoral consequences. That barrier of independence has now been breached. On January 15, 2026, the Department of Justice served grand jury subpoenas to the Federal Reserve, citing cost overruns in the renovation of the Eccles building. Washington insiders recognize this as a pretext: legal groundwork to remove Jerome Powell for cause before his term expires in May. Under the Federal Reserve Act, a chair can only be removed for inefficiency, neglect, or malfeasance, not policy disagreements. This legal maneuver is the playbook to force a leadership change. The financial markets reacted instantly. Within 48 hours of the DOJ announcement, gold surged past $4,600 an ounce, setting a new record. The dollar weakened significantly against the euro and yen, and bond traders began dumping U.S. treasuries. This sell-off was not driven by an organic fear of inflation, but by the realization that the Fed will be politically forced to allow it. Analysts term this the sell America trade. Global investors have determined that U.S. assets now carry a political risk premium, a classification previously reserved for unstable economies like Turkey, Argentina, or Venezuela. On January 20th, 2026, the administration's 10% credit card rate cap comes into force. While a 10% limit sounds beneficial compared to 25% rates, the mathematics of banking renders it disastrous. The bank's base cost of funds is tied to the prime rate, currently 6.75%. A 10% cap leaves a margin of only 3.25%. This margin must cover credit losses, 2 to 3% for prime, over 10% for subprime, operating costs, fraud detection, and transaction processing. According to the American Bankers Association, under this 10% cap, between 82% and 88% of all credit card accounts become mathematically unprofitable. Banks do not maintain unprofitable accounts, they close them. This creates a catastrophic outcome for the 47 million Americans with subprime credit scores, FICO below 660. These individuals will not cease needing credit for emergencies, but they will be exiled from the banking system. They will be forced toward payday lenders charging effective APRs of 300% to 400%, pawn shops, and illicit lending circles. This policy, ostensibly designed to protect consumers from high interest, creates credit deserts. Even credit unions and member-owned cooperatives have formally warned the president that they will be forced to halt lending to their own members to survive. Furthermore, the rewards ecosystem, airline miles, and cashback points is funded by interest income. When that revenue evaporates, so do the rewards. the entire system of consumer perks is effectively dismantled. Simultaneously, the housing market is being manipulated. On January 8, 2026, the administration directed the Federal Housing Finance Agency to order Fannie Mae and Freddie Mac to deploy $200 billion of retained earnings to purchase mortgage-backed securities. The objective was to artificially suppress mortgage rates below 6%. While rates briefly dipped, the structural damage is immense. Fannie Mae and Freddie Mac possess combined capital reserves of roughly $170 to $180 billion. The order to spend $200 billion effectively wipes out the safety buffer built since the 2008 financial crisis. This capital was the firewall protecting taxpayers from future bailouts. It is now being liquidated for a short-term, midterm strategy. Additionally, this move kills any prospect of privatizing these entities, as no private investor will deploy capital into institutions where reserves can be commandeered by the White House. Crucially, lower rates stimulate demand, but they do not fix the supply shortage. The U.S. housing market is millions of units short, exacerbated by the lock-in effect, where homeowners with existing 3% mortgages refuse to sell. Injecting $200 billion of demand into a supply-constrained market results in basic economics. Prices rise. The reduction in monthly interest payments is negated by the increase in the home's purchase price. This benefits existing asset holders while making entry even more difficult for first-time buyers. We are witnessing the weaponization of interest rates. With inflation currently sticky at 3%, the orthodox economic response is to maintain elevated rates. However, forcing the Fed to cut rates for political expediency sustains zombie companies, firms that survive only due to cheap debt servicing. This prevents the necessary economic process of creative destruction, where weak companies fail and capital flows to productive ones. By suppressing rates, we repeat the errors of the 1970s when President Nixon pressured Fed Chair Arthur Burns to keep money cheap, resulting in an inflationary explosion that required a brutal recession to fix. The emerging economic architecture is defined as financial repression. This strategy deliberately keeps interest rates below the rate of inflation, forcing savers to accept negative real returns. It acts as a stealth tax on cash and bondholders. With high-yield savings accounts projected to drop to 3.7% in 2026 against 3% or higher inflation, the real return on savings approaches zero. This benefits the government, allowing the $34 trillion national debt to be serviced more easily while inflating away its real value. The cost is borne by pension funds, retirees, and anyone holding U.S. dollars. In an environment where the currency itself has become a political tool, the standard financial playbook is not just obsolete, it is dangerous. The 60-40 portfolio strategy, which relied on U.S. Treasuries to protect you when stocks fell, is mathematically dead. Why? Because when the government suppresses yields below the rate of inflation to fund its own debts, bonds are no longer a safety hedge. They are certificates of confiscation. You must understand that holding cash is no longer a neutral position. In a regime of financial repression, cash is a guaranteed liability. If real inflation is running at 5%, driven by tariffs, spending, and monetary debasement, and your bank pays you 3%, you are not saving, you are bleeding purchasing power. You are effectively paying a wealth tax simply for the privilege of liquidity. The dollars in your savings account are like ice cubes in a warm room. They may look the same tomorrow, but their substance is melting away by the hour. This reality validates the aggressive surge in hard assets. Gold hitting $4,600 an ounce is not a speculative bubble. It is a rational market response to the debasement of paper currency. Central banks around the world are buying gold not to get rich, but to de-risk their reserves from the US dollar. For the individual, holding physical gold or commodities is the only way to opt out of the banking system's counterparty risk. Similarly, The resilience of real estate values is a flight to utility. In a world of paper promises, investors are demanding assets that physically exist, cannot be printed by a central banker, and provide essential utility. The goal is no longer growth. The goal is the preservation of purchasing power against a currency that is being sacrificed for political expediency. Furthermore, geographic diversification has shifted from a luxury for the ultra-wealthy to a necessity for the middle class. The Sell America trade implies that domestic assets are now vulnerable to sudden regulatory shifts, capital controls, or windfall taxes. If your entire net worth is denominated in US dollars and domiciled in US banks, you have a single point of failure. Holding assets outside the dollar's jurisdiction, whether in foreign equities, non-dollar currencies, or international real estate, creates a firewall. It protects you against the specific risk of U.S. institutional decline. If Washington decides to change the rules of the game overnight, having capital positioned outside that game board is your only insurance policy. On the liability side, debt reduction becomes critical. Do not be lulled into complacency by the 10% credit card cap. This is a temporary sedative, not a cure. When that price control expires, or when the credit markets seize up entirely because banks refuse to lend, the snapback will be violent. Variable rate debt is a trap in a volatile economy. If you are carrying leverage, you are betting that your income will rise faster than the cost of servicing that debt. In a stagflationary environment, where costs rise but wages stagnate, that bet is fatal. The priority must be to eliminate consumer debt immediately, essentially deleveraging your personal balance sheet before liquidity dries up completely. We are living through a fundamental transformation of the American financial system. The signals that used to guide our decisions, price signals, are being systematically destroyed. The cost of credit, the valuation of homes, and the stability of the currency are no longer determined by the honest interaction of millions of buyers and sellers. They are being overwritten by political directives from the White House. This is the textbook definition of a managed economy. We are transitioning away from free market capitalism toward a system where economic outcomes are decided by proximity to power. Historically, such interventions always follow a specific trajectory. They begin with price controls, evolve into supply shortages, lead to capital controls to stop money from fleeing, and end in a massive correction of value. The distortion of the price of money is the original sin of economics. Once you break that, you break everything else. The question you must ask yourself is not if the damage will occur. The mathematics make the damage inevitable. The question is whether you will be positioned to withstand the fallout. When the artificial supports are removed and the market finally reprices risk to its true level, wealth will not just be destroyed, it will be transferred. It will transfer from those who trusted the political narrative to those who prepared for the mathematical reality.